Okay, good evening, everybody, and welcome to all of you at ACCA Prepare to Pass session. My name is Ahmad Sarwar, and I'm your facilitator for this presentation. And today is day 3, and we are going to start from the past papers of day 3. In day 1, I have given the assignments about question number 1 of the consolidation for March, June session, and December, September session of 2016. So I have given you the question to solve for the consolidation and some of the IFRS related questions of question number 2 of both the exam past papers. But I only have received few emails from the student side. So please do attempt the questions that I'm giving to you and try to solve these questions at home repeatedly. It will improve your concepts and definitely it will add value in your knowledge and your skill to pass the paper. So let's start. The first slide. This is the format of the paper that you all have known, and it is highly recommended to please read the articles which I have mentioned in day 1 slides. Please read all the relevant articles of paper P2 and try to memorize the basic key concepts of IFRS. And tomorrow I will share the slides of all the IFRSs. Because of some busy schedule, I will not be able to give you the slides and the notes of the summaries of the IFRS, but inshallah tomorrow I will give you the slides and the notes of the summaries of IFRS on the WhatsApp group. So I hope all of you are now added in the WhatsApp group. Please click on the link for the WhatsApp group and add yourself in the group of paper P2 so that I can give you the summaries of all the handouts. So I think it's a wrong one. Let's can take a break for a minute because the slides are not up to dated. Can you give me So welcome back. Sorry for some inconvenience because of some communication gap. Uh, the management has uploaded the wrong slides. Please download the handouts from the handout section. This is the updated version of day 3 handout. So let's start the first slide. Now here we have a question from the consolidation, that is from the past paper, that is relating to the parent company, that is bubble company, the salt, and the taster company. So we have 3 companies. So I have to change the color of the pen. It should be red. Okay. So we have 3 companies, but the key point is that the parent company's currency is dollars. The salt company has a currency of dollars, and at the same time, the Tesla company has dinars. So this is one of the most important points that says that it is a consolidation question relating to the foreign currency. So the simple balance sheet has been given to you. So starting from the first note that the bubble had acquired 80% shares. So again, I have break the question into different parts of the consolidation, and I'm just working on the note 1. And I have, as I have already told you, that the working one has nothing to do, or the goodwill has nothing to do with note number 2, 3, 4, and 5. So you can just pick note number 1, and without reading even note 2, 3, and 4, you just solve the question and you can calculate the goodwill in the salt company. So the bubble company has acquired 80% shares in the salt company. So salt company and the bubble company's currency is same. Both have got the dollars. So there is no implication of the foreign currency transactions. So you can easily see that the bubble company has acquired 80% shares in salt company on 1st November 2013, 2 years back, when the salt company has a retained earnings of 56. And the other component of equity is 8. The fair value of the net assets is 120. And at the day that this does not include contingent liability, which was disclosed in salt. So according to IS 37, the contingent liabilities, if the chances of the payment is possible, it should be disclosed in the notes as the company has disclosed the amount. But for the purpose of consolidation, you have to recognize all the possible obligations. So the contingent liability should be provided for the purpose of consolidation. So this does not include a contingent liability which is disclosed in the financial statement as a possible obligation of 5 million. The fair value of the obligation was assessed as 1 million at the date of the acquisition and remained unsettled at 31st October 2015. $5 million is still disclosed as a possible obligation with no change in its fair value. And the remaining difference in the fair value of the net asset at the acquisition to the non-current asset relates to the non-depreciable land. So there might be a fair valuation adjustment, which could be an upward or a downward fair valuation adjustment. That adjustment should have to be adjusted in the consolidated balance sheet. The fair value of the non-controlling interest at the acquisition was 25. So all the data is simply given to you. So you are required to calculate the goodwill. So please calculate the goodwill from this question. And please, so we can't see the question. How? You have to download, actually you have to download the file in your PC from the handout section that is mentioned in the handout. We have day 2 handout and day 1 handout. So you have to pick day 3 handout today. Please download this file so that you can see the question on your paper, on your PC. So, okay. Now please solve the question and calculate the goodwill and write the answer in the chat box. Please write your answer relating to the goodwill in the chat box. I want to see your answers. I cannot see the cash consideration paid for the salt. The cash consideration for the parent company, you can see if the data is not given to you, you can pick the data from here. That is, the bubble company has invested 110 million in the salt company. So please write the answers relating to goodwill in the chat box. One of the answer is goodwill is 16 million. Goodwill is 15 million. So let's start. Goodwill. The cost of the investment is 110. The NCI at the acquisition is 25. Fair value of the non-current assets, net assets, is 120 million. But as the question says that this does not include a contingent liability which was disclosed, and the present value of the contingent liability is 1 million. So the final amount of the net assets is now 119. So by incorporating 1 million of the provision according to IS 37 in the net assets, you will find and get the value of the adjusted fair value of net assets, and that is 119 million. So the final amount for the goodwill will be, that's 110 plus 25 minus 119, and the goodwill is 16 million. Now if you have any question about the goodwill, please do ask it immediately so that we can discuss your question and problems. Yes. 16 million. Any question about the 16 million? Please do ask. Explain 119. Okay, 119. As you can see here, that there is a contingent liability that has a fair value of 1 million. So the accounting entry for the recognition of the contingent liability as a provision will be retained earnings debit and provision credit. That will be 1 million. So at the date of acquisition, you can see that we have to adjust the retained earnings which is included in the fair value of net assets. So fair value of net assets without incorporating this liability is 120 million. Or you can say that when the liability of the business has increased, the net asset value will decrease by 1 million, because we have calculated net assets by taking asset minus liability. So liability, when we increase the liability, the net asset will go down. So the final value of the net asset is 119. So the fair value of the net assets is 119. And do remember this point, that the contingent liabilities which are disclosed according to IS 37 must be recognized for the purpose of consolidation. So when we take and when we consolidate the things, we have to recognize all the intangible assets, and secondly, we have to take all the contingent liabilities as a provision. So you have to book the liability, and when you book the liability for the 1 million, the fair value of net assets will go down and it will be 119. So the question is, can the contingent liability affect at the reporting date net assets? The contingent liability, when we record it, and if the amount is not settled up till the reporting date, then it should be adjusted at the reporting date. So if the amount is not yet settled at the reporting date, then it should be adjusted. Which paper, monthly or year we are working on today? Okay, today we are working on September-December 15 exam. So it's a hybrid paper for September and December attempt 2015. So any other question from this slide? Will we practice cash flow? I think it's useless to work on the consolidated cash flow because it already appears in September attempt. But if you want, so I can revise the basic concept of the cash flow tomorrow. What happened to the 5 million? The 5 million is actually the possible obligation that we have disclosed, but we have to take the fair value of the contingent consideration, which is actually 1 million. And subsequently, 5 million is still disclosed as possible obligation with no changes in its fair value. So there is no change in the fair value, means we have to adjust only 1 million rather than 5 million. So all the liabilities, when we record it for the purpose of consolidation, should be reported at the fair value. Why is the liability provided for if the obligation is not probable? Actually, we are following the provisions of IFRS 3, which says that for the purpose of consolidation, you have to disclose, you have to recognize all the assets and liabilities of the subsidiary company. Okay, you have to recognize all the assets and the liabilities of the subsidiary company. Even we do not recognize it on the balance sheet of the subsidiary company. Like in the case of IS 37, if there is some possible obligations, you have to recognize it for the purpose of consolidation. Similarly, I'm giving you the example of IS 38. In IS 38, we have studied that the research component should be recognized as an expense and development should be capitalized. But for the purpose of consolidation, even the research component can be capitalized. Similarly, IS 38 says that we cannot recognize the internally generated, like intangible assets like internally generated brands, internally generated mastheads, internally generated other intangible assets. But for the purpose of consolidation, you have to recognize all the intangible assets, even if it is not recognized for the in the subsidiary's balance sheet. I'm sorry, I have an irrelevant question where I can find the videos of the session. The videos of the sessions can be found on the platform at ACCA platform with the name Vimeo. It's Vimeo. You can see the videos on the Vimeo, like it's a platform like a YouTube. So you can download the Vimeo in the cell phone, or you can visit on the Vimeo website and you can search ACCA Prepare to Pass. You will find the videos over there and you can revise the session. So why we get 1 million as contingent liability rather than 5 million? I'm already discussed this point. The key point for this is the provision, the possible obligation is disclosed and estimated as 5 million, but for the purpose of consolidation, we always work on the fair values. So if the fair value is different from the different from the amount disclosed, then you have to take the fair value. So the 1 million is the relevant figure. So moving towards the next slide. Yes, Bubble Company also owns 60% equity shares of Teisler Company, a company located in overseas. So there is a implication of foreign currency transaction, and the functional currency of that company of that country or company is dinar. The shares in the Teisler were acquired on 1st November 2014 at a cost of 368 million dinars. At the date of acquisition, the retained earnings were 258, and the Teisler has no other component of equity. So no fair value adjustment were deemed necessary in relation to the acquisition of the Teisler. The fair value of the non-controlling interest was estimated at 220 billion. And an impairment review of the goodwill was undertaken. That there is no impairment was necessary in relation to the salt, but the goodwill of the Teisler is to be impaired by 20%. So there is an impairment in the value of the goodwill of the Teisler. And do remember this point that Teisler's functional currency is dinar. So you have to convert the values from dinar to the dollars. So what we do for this type of the question, the first approach that we follow is to calculate the goodwill in local currency of the subsidiary, that is dinars. So please do calculate the value of the goodwill in dinars. So I'm giving you just 1 minute to calculate the goodwill in dinars. Please do calculate the goodwill in dinar. I'm giving you just 1 minute. So the first requirement is to calculate the goodwill in dinars. So whether the cost of the investment is given to you in dinar, the answer is yes. We have been given the cost of investment in dinars. Oh. If the question yes, if the question did not tell you about the cost of the investment in the functional currency of the subsidiary, so you have to take the value from here, that is 46 million, and convert the value of this cost of investment from dollar to dinars by taking the rate, exchange rate on 1st November. So you can see that at 1st November, the rate is 8. So by multiply 8 multiply by 46, we got the value of 368. So as we have already given in the question that there is a value of 368 million dinars, but if the value is given to you in dollars, you can convert the value from dollars to dinars. So the cost of the investment is 368. Then we have to add the value of the NCI at the date of acquisition, which should be in dinars. That is 220 million. So the overall cost of the investment or the total value is 588. Less we have to deduct the fair value of net assets. There is the fair value of the net assets is at the date of acquisition, the retained earnings were 258. So we have to take the share capital plus date of acquisition retained earnings, that is 258, and you can see that there is no fair valuation adjustment in the question. So the value of the goodwill will be 120 million. So 588 minus 210 minus 258, you got the value of 120. Is it done? Which paper is this? Is actually a hybrid paper for September and December 2015 attempt. Done? Now, the first step is to calculate the value of the goodwill in dinars. The impairment loss is 20%. So the impairment loss is 24 and the final value is 96. Now you are required to translate all the values from dinars to dollar at the exchange rate of the date of the transaction. So the goodwill at the reporting is 96 and at the reporting date the rate is 9.5. So we have to use the rate of 9.5 to calculate and to convert the goodwill at the reporting date in dollars. So 96 dinars divided by 9.5, we got the value of 10.1. Where did you get the share capital? Share capital is here. We have taken the share capital of the subsidiary company. So if the fair value of net asset is not given, we can calculate the share. We can calculate the fair value of net assets by adding the share capital, retained earnings, and OCE and revaluation reserve at the date of acquisition. Now, 368 is the date of is the value of the investment on 1st November. So we have to take the rate of 8 for this, then 8 for this, and 8 for this value as well. So by dividing 368 by 10 by 8, we got the value of the in dinars. In dollars, it is 46 million. For NCI, it is 8, that is 28. So 588 divided by 8, it's 73.5 actually. It is actually 27.5 exactly. So by dividing the total net assets by 8, that is 468 divided by 8 is 58.5. So the value of the goodwill before the impairment is actually 15 million. So when we take the conversion of the impairment loss, so when we convert the value of the impairment and the date of the impairment loss is 31st October, and the impairment loss is actually an item that should have to be charged in the income statement. So the conversion rate for the impairment loss should be 8.5. So we have to take 8.5 for this impairment. 24 divided by 8.5, we got the value of 2.8. So according to the rates and the figures in the dollar, the goodwill at the reporting date should be 12.2. But our goodwill is now 10.1. So from 12.2 to 10.1, there is a further impairment loss. Sorry, there is a further exchange loss because of the change in the rates, and the amount of this is 2.1 actually. So 2.1 is actually the exchange differences in the valuation of the goodwill. When we retranslate the goodwill from the acquisition date rate to the reporting date rate, so there is a difference of 2.1 which should be shown as exchange loss in equity. So now if you have any question, what is 24? Where is 24? 24 is actually the impairment loss. As you can see in the question that there is 20% impairment loss in the question. So by taking 20% of the goodwill, we got 24 impairment loss. Okay, I see. At the reporting date 10.1, goodwill 31st October. Yes, 2.1 exchange rate. Can I just divide 120 million dinars by the exchange rate at the acquisition to get the goodwill at the reporting date in dollars? Yes. You can divide 120, but you will find that goodwill at the acquisition date rather than the reporting date. So we actually want the goodwill at the reporting date for the preparation of the balance sheet. So first of all, you have to calculate the goodwill in dinars, then you have to convert it with the closing rate. Where does 210 comes from? 210. It's not 210. Where does 210 comes from? There is no 210 in the question. Okay, 210 is actually the share capital of the Tesla company. So you can see from the balance sheet here that the 210 is actually the share capital of the Tesla company that should have to be added for the calculation of the fair value of net assets. Because in this part of the question, the fair value of net asset was not given to you. So you have to calculate the fair value of net assets by adding the share capital and reserves at the acquisition date. Can you please repeat the exchange loss? How will it consider it as a loss? Okay. So can't we just divide 96 by 8 and 96 by 9.5 and then compute the foreign exchange gain or loss? Yes, you can do this, but the difference in the exchange loss will be wrongly calculated, I think. You can do this working, but because there is a concept of impairment loss at a different date, therefore we have to take these values and solve the question in this manner rather than taking the values at just 8 and 9.5. Can exchange loss be found out by the converting it with the opening rate and then comparing it with the closing rate? Yes, the exchange loss will also be calculated on the basis of changes in the exchange rate and the fair value of net assets. Why we are dividing impairment by 8.5? Actually, the impairment should have to be charged in the income statement. Therefore, for income statement items, we have to take the average rate. Income statement, according to IS 21, for the conversion of the foreign currency items, balance sheet related items should be converted at the closing rate, but the income statement related items should be translated at the average rate. Where will the loss be reported? This loss will be reported in the equity section. In actually the exchange losses, overall exchange losses heading should be used in the balance sheet in the equity section. Yes, there is a demand from one of the student to recalculate just the goodwill in dinars, rate, and dollars. So we have calculated already the value of the goodwill in dinars. The value of the goodwill in dinars is 120. The exchange rate at the date of acquisition is 8, and this value in dollars is 15. So if we deduct the impairment loss, that is 20% value, that amount will be 24. We got the final value of the goodwill at 96. So in dinars, the goodwill at the reporting date is 96. So when we convert the 96 value at 9.5 rate, that is the closing rate, then we got the value of 10.1. And when we charge the impairment loss in dollars, the rate should be 8.5. So 24 divided by 8.5, we got the value of 2.8. And the difference after deducting is now 12.2. So actually the goodwill at the acquisition after deduction of the impairment loss is 12.2, but according to the closing rate it is now at 10.1. So there is a loss in the value of the goodwill due to exchange rates movements. This exchange rate loss should be reported in equity as the exchange rate losses. A number of questions from the students. Okay, one by one. Why we are dividing impairment by? Okay, we have already responded to where will we report it? Okay, does it means that we should prepare both before translation and then after translation to get the exchange loss or gain? Yes, you're right. The foreign exchange loss is charged to equity or retained earnings. Actually, it should be reported in the equity separately from the retained earnings. Only the foreign exchange gain or loss on the monetary item retranslation should be reported in the income statement and retained earnings. but the exchange gains and losses that appears on the translation of a foreign operation should be reported in equity. Foreign exchange affects the parent companies only. Foreign exchange losses affects the parent company only. No, it will not affect the parent company. It is actually affects the subsidiary companies, other component of equity. So we have to use the term exchange losses, foreign exchange gains, and foreign exchange losses on the translation. So that's it. Next slide. Moving towards the next slide. Now, there's an adjustment for you. That adjustment is relating to the exchange gains and losses. So you are required to please attempt this part. To just 1 minute to please attempt this part of the question. Yes, the question is, exchange losses will be always be reported in OC. Sorry, it should not be reported in OC. There is actually a separate account with the name foreign exchange reserves or translation reserve. In that we have to report all the exchange rates, gains or losses on the translation of foreign operations. So there is a separate account with the name exchange reserve or translation reserves or exchange rate reserves. And a P&L. In P&L, we only recognize the gain or loss on the retranslation of monetary items. So what you are saying, we should calculate? Yes, you are required to calculate the gain or loss on the foreign exchange and the adjustment of this part of the note 3. Please do calculate and try to solve this part of the note 3. So let's start. Bubble gave an interest-free loan. So Bubble company has given the interest-free loan to the Tesla. That is investment in the books of Bubble for 10 million. But as you know that in the liability section of Tesla, it should be recorded, the liability section of the Tesla, it should be recorded in dinars. So the exchange rate on 1st February is 9. So by multiplying 10 million into 9, we got actually the loan of 90 million in dinars. Okay. So Tesla repaid 5 million. So half of the loan is being repaid, and the remaining half is still unpaid. That is 10 million. Okay. So in the balance sheet of the Bubble company, this transaction will be considered as a foreign currency monetary transactions. Okay. So parent company has given the loan, and the subsidiary company has recorded the amount of 90 million in its liability. And then subsequently, they have paid 5 million out of the overall liability. So when the subsidiary company is going to pay to the parent company, the rate is now 10 dinars, $1 to 10 dinars. So how much amount that should have to be paid for the calculation of and payment of $5 million? So we have to use 50 million dinars. That is 5 multiplied by the rate is 10 at that date. So there will be 50 million dinar value. So out of 90 million, we have paid 50 million, and the remaining liability is now 40 million in the books. Okay. That's fine. Now the remaining liability, when we retranslate the foreign currency monetary items, it is actually the foreign currency monetary items. The remaining liability of the subsidiary company is still $5 million. You have to pay further $5 million, and at the year end, the rate is now 9.5. So by multiplying it with the 9.5, 5 into 9.5, we got the value of 47.5. So in the books, our liability is 40 million, but the revised liability, when we retranslate the monetary items at the closing rate, the revised liability is 47.5. So there is an exchange loss of 7.5. So this is actually the exchange loss of 7.5 due to the retranslation of monetary items in the books of subsidiary company. Therefore, we have to charge the whole amount in the retained earnings. So do remember this, that this loss should be charged in the income statement or retained earnings. So the accounting entry should be retained earnings debit and non-current liability credit. That is 7.5. So the retained earnings should be debited by 7.5 and the non-current liability should be credited by 7.5. So we are actually debiting the retained earnings of the subsidiary company. So therefore we have to distribute the amount into group share and NCI share. So as it is an adjustment in the books of subsidiary company, this is an adjustment in the books of Tesla company. Therefore, this adjustment will also affect the non-controlling interest as well. Okay. So we have some questions. Exchange loss of 5 million dinar. No, it's 7.5 dinar. Shouldn't the exchange loss of 5 million dinar be recognized at the date of the repayment? An exchange loss of 2.5 dinar, or is this unnecessary? I think it is unnecessary to calculate because we have paid half of the amount and the remaining half is still unpaid. So both the adjustments of the previous and the current amount will be adjusted in 7.5. So even we can calculate the separate 2.5 million and 5 million, but I think the most time-saving approach is what I'm doing. In the eyes of Tesla, there is a 7.5 dinars, but what about the group? No money went outside of the group. Yes, there is no money went outside the group. Therefore, when we retranslate the amount and 47.5 will be converted to $5 million, this will considered as an intercompany transaction between the parent and the subsidiary. So finally, the amount of the parent and the subsidiary will be cancelled out in the consolidated balance sheet. So first of all, you have to restate your liability, and then this amount will be adjusted and cancel out with each other. Where the 40 comes? Actually, out of 90 million, we have paid 50 million because of the exchange rates movements. We have paid 50 million. So we have recorded the liability at 50 and 90, and we have paid 50 already. So the remaining difference will be recorded in the liability section already. And when we restate this liability, it will become 47.5. So there is a difference of 7.5, which should also be recognized and recorded. This 7.5 in the parent companies. How will the reporting this 7.5 in the parent company's financial statement? It will not affect the parent company's financial statement. This 7.5 will be adjusted in the post-acquisition profits of the subsidiary. So it will affect the consolidated retained earnings and non-current liabilities of the subsidiary. Is it clear? Let's move on towards the next slide. That is, I'm giving you, it's a similar type of adjustments. I'm giving you just 1 minute to please solve this part of the question. It is also relating to IAS 41-21 foreign currency. Please solve this. There is a question from the student. There's a question that, can you explain when the foreign exchange gain or loss goes to the equity or retained earnings? Actually, according to IS 21, according to IS 21, the exchange gain or loss on the monetary items should be recognized in the income statement. For balance sheet question, it would go in the retained earnings. But for the retranslation of the foreign operation, like for the translation of income statement complete or balance sheet of the subsidiary, the exchange gain or loss will go in equity directly. And in which account? It should be shown in an account with the name of translation reserves. Translation reserves or foreign exchange reserves. Okay. Any other question? Okay, let's start this question. Bubble wishes to expand its overseas operation on 1st May 2015 and the year end is 31st October. Like you can count the months May, June, July, August, September, October, just 6 months before the year end. So the bubble company wishes to expand its overseas operations and on 1st May acquired an overseas property with a fair value of 58.5 million. So the fair value is 58.5 million dinars. So what is the exchange rate at this date? So 58.5 divided by 1st May rate, that is 9. We got the value of 6.5. Okay. Bubble paid the supplier with the land which Bubble had held but had not yet to determine its use. The carrying amount of the land was 5 million, but it had an open market value of 7 million. So we have purchased an overseas property in exchange of a land. So the land which we use for the exchange has a carrying amount of 5 million and had a market value of 7 million. So according to IS 16, the transaction has a commercial substance. This transaction has got a commercial substance. Then it should be valued at the fair value of the asset given up. So we are giving the asset of land, so it should be valued at the value of land. So the property should be recorded initially at 7 million rather than 6.5 million. So because we are purchasing the property in exchange of a land. Okay. But we have to book a gain on the disposal of the land, that is for 2 million. 7 minus 5 is equals to 2 million. So this property that we have acquired on 1st May 2015, the bubble was unsure as to how to deal with the transaction and has transferred 5 million from the investment property to the property, plant and equipment. The transaction has a commercial substance. The transaction has a commercial substance. In addition, the bubble spent 0.5 million to relocate the staff. So the cost of the relocation according to IAS 16 should also be recognized as an expense. So we have to charge this amount in the income statement as an expense or as an adjustment in the retained earnings. So it will be deducted from the retained earnings of the parent company. Okay, and added this amount to the cost of the asset. Bubble has made no other entries in its financial statement. So the company has capitalized this amount. So you have to deduct the amount from the asset and you have to charge this amount as an expense. Bubble has made no entries in its financial statement in relation to the property. Bubble has a policy of depreciating property over 35 years. So we have to charge a depreciation for this property having a cost of 7 million divided by 35. We got the depreciation of 0.2 divided by 2 for the first 6 months. So for the first 6 months, we got the depreciation of 0.1 and the net book value of this asset will be 6.9 million. Then the question says that due to the surge in the market, it is estimated that the fair value of the property is now the fair value of this property, because the company is following the revaluation model, so you have to revalue. It's actually the revalued amount, which is 75 million dinars. So by dividing 75 with the exchange rate at the reporting date, that is 9.5. So 75 divided by 9.5, you got the value of 7.89. So there is a revaluation gain that should have to be shown in OCI and revaluation reserve, that is 7.89 minus 6.9. The value is 0.99. So there is a revaluation gain of 0.99. So if you have any confusions about this adjustments, you can ask it immediately. Does the OCI and the reclassified to P&L? No. 58.5 or 6.5. It is the difference in the fair value of the two prices of land. How the revaluation is reported or used. The revaluation of 0.99 will be reported in the revaluation reserve of the parent company, and from the balance sheet perspective, this property will be valued at 7.89, approximately 7.9. How was the gain of 2? The gain was calculated by taking the value difference of 5 and 7, because we have a land in the investment property having a book value of 5, but we have sold this land at a value of 7. So the difference between the carrying amount and the difference between the consideration received is 2 million. The 0.99 can recognize another component of equity as well. There is a question that the 0.9 goes to the other component of equity. So you can recognize this in other component of equity, or you can open a revaluation reserve account for this. Any other question? Any other question, please do ask immediately. I think it's fine. So let's move on towards the next slide. Now we have another question for you, another slide for you. So please try to attempt this part so that we can start further. I think it's a very simple area relating to IS 19. Okay, so let's start. Bubble operates a defined benefit scheme for its employee, but it has yet to record anything for the current year except for the expenses. The cash contribution, which was 6 million. The cash consideration was 6 million. The opening position, net liability. So net defined benefit obligation is 15 million. It included non-current liability of bubble in its financial statement. Current year service cost is 5. It's very simple. High quality corporate bonds fell from 8% at the start of the year to 6% by 31st October 2015. So what rate we should have to use? So finance cost should be calculated at 8%. So by taking 15 into 8%, 0.08, we got the value of 1.2. Then in addition, the payment of 3 million was made out of the cash for the pension scheme in relation to the employees who left the scheme. So there is a settlement of 3 million cash. The reduction in the pension scheme liability as a result of the curtailment was 4 million. So from the liability side, we have to reduce 4 million, and from the plan asset side, we have to reduce the 3 million. So the net adjustment is 1 million. That is actually gain on settlement. Then the actuary has assessed that the scheme has a deficit of 17 million at the reporting date. So defined benefit obligation at the reporting date is 17 million. Now, is there any contribution paid here? Contribution paid into the scheme, yes. The contribution paid is 6 million. So the difference will be considered as a remeasurement component, which could be a gain or a loss. So 15 plus 1.2 plus 5 minus 6 minus 1 minus 17. So there is a difference of 2.8. So actually the liability has increased, so it is a remeasurement loss actually. So this remeasurement loss will be recognized in OCI. Finance cost will be reported in the income statement or retained earnings for the balance sheet question. Service cost will also be charged in the retained earnings or income statement. Contribution paid, no adjustments. Gain on the settlement will also be shown in the retained earnings. So these are the adjustments that we should have to recognize in the retained earnings. So if you have any question, you can ask it immediately. Okay. The gain on the settlement, that a payment of 3 million was made out of the cash for the pension scheme in relation to the employees who left the scheme. So from the plan assets of the pension scheme, we have paid 3 million, but the liability adjustment is 4 million. So in fact, you can say that the liability of 4 million is going to be adjusted with the settlement of just 3 million. So there is a gain of 1 million that should have to be booked in defined benefit obligation. Any other question? The 3 million is put under the plan asset. Yes. The 3 million amount, actually we are working on a net liability. It's not only the liability area. Actually, we are working on the net liability concept, means asset liability minus asset. So it is, we are working on the net basis. So therefore, we are recognizing the adjustments of the plan assets and the liability on the net basis. So therefore, we have a gain on the settlement is 1 million. So do remember this point, that this value is not only for the liability. It's not the present value of the DBO. It is actually the net liability after deducting the value of the asset. So we are working on net basis actually. Do the 6 million contribution will be reduced our funds or not? The 6 million contribution will increase the plan assets. But as we are working on a net liability basis, therefore it will decrease the net liability. Benefits paid given. How does we put the, okay, the benefits paid actually will be adjusted from the liability and the asset at the same time. Therefore, there will be no adjustments of the benefits paid in net liability concept when we are working on net basis. Usually, defined benefit scheme, we always do the calculation in net basis. From the consolidation question point of view, yes, you can say that the examiner will always give you the values for net basis, but practically and in other questions, the examiner can give you liability and assets separately. And will it reduce our assets? Contribution paid, yes, it will reduce. It will increase the assets, actually plan assets, but actually we are working on net basis, therefore it reduces the net value. And why we use 8% interest? Actually 8% is the rate for the current period, and this rate is reduced to 6% on 31st October. It means that this rate will apply on the next year. So the 6% rate will be applied on next year, but throughout this period, this 8% rate prevails. Therefore, we have applied and calculate the values at 8%. I cannot read what is written next to 2.8 million loss. 2.8 million because remeasurement component. It's actually remeasurement component. So what will be the double entry for the contribution paid? When we paid the contribution, we have to debit the plan assets and crediting the value of the assets like cash or bank. So plan assets should be debited and bank or cash will be credited when we pay the amount in the plan assets. So as we have some time, I'm giving you just 2 minutes to calculate the NCI, because we have already calculated the goodwill component. You are required to calculate the NCI and the retained earnings and foreign exchange loss or gain on net assets. So I'm giving you just 1 minute to please solve the retained earnings. Where we are right now, we are here. I'm just adding the value, additional slide. So for this slide, we have to calculate the retained earnings, NCI, and exchange losses in total. On goodwill, we have already calculated the exchange loss. I think it's 2.1. And now you are required to calculate the exchange loss on net assets. Secondly, calculate NCI of both the companies because it's a foreign exchange. This question is relating to foreign exchange consolidation. I want all of you to please do the calculation so that you will be comfortable for these three calculations. So you are required to calculate the retained earnings, NCI, and exchange losses for all these questions. Please do solve. Right now I'm giving you just 2 minutes to solve. Okay, so let's start. For retained earnings, the retained earnings of the parent company, that is Bubble, is 230. You can see on the first slide that the retained earnings of the parent company is 230. Then there is a gain on the disposal of property, plant and equipment, that is 2 million. Then we have relocation cost, that it should also be charged in the retained earnings because the company has mistakenly capitalized this amount. Then we have depreciation of the 7 million component that we have calculated, that is 0.1. This amount should also be adjusted here. Contribution paid was mistakenly charged in the retained earnings, therefore we are reversing its impact. Service cost and finance cost, both should be charged in the income statement, that is 6.2. The gain on the curtailment is 1. 4 minus 3, that is 1. Impairment in the value of the goodwill of Teisler. Impairment in the value of the goodwill in Teisler is actually 2.8, but we have to book 60% of this amount. So 2.8 into 60% will be 1.7 approximately, or 1.68. When we have to take the post-acquisition profits of Salt company, in which our share is 80%, and the post-acquisition profit is now retained earnings at the closing is 74, minus at acquisition it is 56. So 74 minus 56 into 0.8, that will be 14.4. And finally the post-acquisition profits of Teisler, the post-acquisition profits is, you can see in the question that the post-acquisition profits of the Teisler is 34, yes, minus we have to adjust 7.5 from it, and we have to divide this with the average rate, that is 8.5, and our share in the Teisler is 60%. So 34 minus 7.5, which is actually the loss on the monetary items, divided by 8.5, we got the value of 3.12 into 60%. Sorry, it's the wrong amount. 3.12 into 60%. We have to take the 60% share of 3.12. The final amount is 1.87. So by adding all these values, we got the final amount of the retained earnings. That will be approximately 268, 246 point something. Please do calculate all this amount. Please calculate all the amounts. You got the value of 246 point something. What is 74.56? It's not 74 minus 7. Okay. 74 you can see in the balance sheet. Okay. You can see in the balance sheet of the subsidiary company, that is the name is Salt Company. You can see the retained earning figure, that is 74, and in note number 1 we have seen that the retained earnings of Salt at the date of acquisition is 56. So the incremental post acquisition profit is 74 minus 76, and our share is 80% in that, so we have to take 74 minus 76 into 80%. So this is how we have calculated the post acquisition profits of Salt, and then we have calculated the post acquisition profit in Tysler, that is 75.34 minus 7.5 divided by 8.5 into 60%. Now I'm giving you one more for the minute to please ask if you have any question about the retained earnings, and then we will start solving non-controlling interest. So we have to solve the non-controlling interest. So you have one more minute. For Salt, NCI at the acquisition date is 25. Then the post acquisition profits of the Salt is 74 minus 56. into 20% should be allocated between the salt. Then we have to take the other component of equity portion, that is 12 minus 8 into 20%. So the value is 3.6 and this value is 0.8. So the NCI in salt only is 29.4. The exchange gain or loss on opening net assets, the exchange gain or loss on opening net assets and the drawings is 9.5, and the total exchange losses is 11.6. So this losses should be distributed between group and NCI. So the 60% of this loss should be bared by the group and the 40% of the loss should be, that is 11.6. So 11.6 into 0.6, that will be 6.9, approximately 7, and the remaining amount will be 4.6 for NCI. So this value should be used for the calculation of NCI in Teisler. For Teisler, the NCI the acquisition should be 220 is the value of the NCI in dinars. So we have to divide this by 8 and the value in dinars will be 27.5. Then post-acquisition profits, the post-acquisition profits into NCI's share will be 3.1. I think it's 3.1, that is 34 minus 7.5. That will be 26.5 into 40% share divided by 8.5. It will be 1.25. The post-acquisition profits will be 1.2. Okay. Then exchange losses is 4.6. And finally there is an impairment, that is 2.8 into 40%. So the final amount of the 2.8 into 40% will be 1.1. So by adding or subtracting, you got the value, final value of 27.5 plus 1.2 minus 1.1 minus 1.4.6, and the final value is 23. So the total NCI will be 29.4 plus 23. Now you have all the workings with you. Now if you have any question, please do ask. What is written before 1.1 in NCI? It is an exchange loss that we have calculated from here, exchange loss of 4.6. Explain the 27.5 for Tesla. Where is 27.5? 27.5 is actually the NCI at acquisition. So you can see in note number 2 that the NCI at acquisition in dinars is 220 million. So at that date, the rate of exchange is 8. So we have to divide 220 by 8. We got the value of 27.5. That is the NCI at acquisition. What is N1.1 in NCI? 1.1 is actually the impairment loss, which is 2.8. You can see note number 2 working, that we have recognized an impairment of 2.2, and the 60% of the impairment loss should be charged in the retained earnings, that is 1.7, and the 40% of the impairment should be recognized by the NCI group. How could I calculate the exchange losses for the net assets? Yes. Now, if you are comfortable with this working, I'm giving you just 1 more minute to please see all the workings in details. And if you have any issue, then we can discuss. Otherwise, we have to calculate the 9.5 amount. How we have calculated this 9.5? So we are going to calculate the 9.5. For this, we have to prepare the translation schedule. Where are you getting the post-acquisition profits? Post-acquisition profits of which company? Are you talking about Salt or Tesla? Post-acquisition profits. Both? Okay. For the post-acquisition profits of Salt, first of all, we have to move towards the previous slides for the reference. Right now we are in slide number 7. Oh my God, it's messed up already. Here in this slide you can see that the retained earnings of the Salt at the reporting date here is 74. You can see here that the retained earnings of Salt at the reporting date is 74, and at the date of acquisition it was actually 56. So this is how we have calculated the post-acquisition profit of the Salt. So the retained earnings at the reporting from the balance sheet minus the retained earnings at acquisition, and the incremental profit of the subsidiary Salt should be distributed between the group and NCI in the ratio of 80 and 20. Then we have this slide. In this slide you can also see that the retained earnings at the acquisition is 258 and the retained earnings at the reporting is 292. So we take the difference between those two. So the difference is 34, and there is an adjustment of 7.5 that should have to be adjusted for the monetary items. So for both the calculations of the retained earnings and NCI, we deduct 37.5 from the 34 and then translate this amount at the average rate, and we take the percentage of 60% for the calculation of retained earnings and 40% for the calculation of NCI. What rate did you use for the Tesla's post-acquisition profits? For the calculation of the post-acquisition profit, we always take the average rates. what we'll be doing of 29.4 plus 2.3. 29.4 and 2.3. Okay. 29.4 plus 23 should be shown on the consolidated balance sheet as a total non-controlling interest. So it is actually the value of NCI of both the companies. So the total NCI of 29.4 plus 23 should be reported on the consolidated balance sheet. So let's move on. Towards the calculation of okay. So now we are going to calculate the exchange loss on assets and profits, that is 9.4. So we are going to calculate the exchange gains and losses of 9.5. So what we are doing is to take the balance sheet values of the subsidiary company, then we have exchange rate, and then we have to calculate the balance sheet values in dollars. So this is called translation schedule that you have to use for the calculation of foreign exchange gains and losses on opening net assets and profits. So starting from one of the non-current asset, that is property, plant and equipment of Tesla, you can see the value is 390. Then we have financial assets, that is 98. Then we have inventories, 16. Trade receivables, inventories. Trade receivables is 36. Cash is 90. Then we have the share capital, that is 210. Reserves, retained earnings, pre-acquisition is 258, and the post-acquisition retained earnings is the incremental amount is 34. Then we have non-current liabilities, that is 110, and we have current liabilities of 18. So this is the overall balance sheet of the Tesla company in dinars. Now we are going to convert by using the exchange rates. So do remember this point, that all the assets should be translated at the closing rate. All the assets should be translated at the closing rate. Similarly, all the liabilities should also be translated at the closing rate. And most important points. Then the share capital and the pre-acquisition reserve should be translated at the rate at the date of acquisition, but the post-acquisition profits should always be translated at the average rate. So all assets and liabilities should be translated at the closing rate. Share capital and retained earnings at the acquisition should be translated at the rate at the date of acquisition. And finally, the post-acquisition profit should be adjusted at the average rates. Now, if we have some adjustments in the monetary items, it should be also be adjusted here so that we can calculate and got the adjusted values. So you remember that for monetary items, we have debited the retained earnings and we have crediting the non-current liabilities. So this is now adjusted here. And by dividing these values, 390 by 9.5, we got the value of 41.1. Then financial assets 10.3. Then we have 1.7, 3.8 trade receivables, cash will be 9.5. These are my total assets. For liability section, we have 12.4 in the current non-current liability and 1.9 in the current liability. For the share capital perspective, the share capital is 26.3 and the pre-acquisition reserves is 32.3 and the post-acquisition profit is 3.1. Now, by deducting assets from the liabilities, or you can just balance the balance sheet, there will be a difference that should be placed here. This difference will be the exchange loss or gain on the retranslation of foreign currency balance sheet. So by taking the difference, you got the value of 9.5. Negative value. It is actually a balancing figure that will appear here. This amount will be used along with the exchange gains and losses on the goodwill. Along with the exchange gains and losses on the goodwill. I cannot hear the webinar. It's common or only me? I think it's only you. Please try to check your mic and speakers. Okay, this is how we have calculated 9.5. What we do, we have take all the assets and liabilities of subsidiary in dinars. We use the rates relevant for assets and liabilities, share capital, reacquisition and post-acquisition profits, and we calculate all the values in dollars, and the differential will be considered as exchange gain or loss. This is what loss or gain that we used for the calculation of retained earnings and NCI. So the translation reserves of the parent company, when we prepare the consolidated balance sheet, it shows that there is a translation reserves of -7. How we have calculated this 7? This is actually 9.5 plus 2.1. For the calculation of goodwill, we got, yes, 2.1. And 60% of this amount should be reported in the translation reserve, and the 40% is we have already adjusted in NCI. Now again, this question has become your assignment for the next class and the next session. So please try to attempt this this part of the question, and I will check your answers tomorrow. So let's move on towards question number 2 of I think we have to take a break at least for 5 minutes. Let's take a break for 5 minutes. Then we start our session after the break. Then we have to solve all the parts, questions of question number 2 and question 3. So taking a break right now. Stay connected. Okay, welcome back. Now we are going to start the scenario. ChemClean trades in the chemical industry. The entity has development and production operation in the various countries. It has entered into an agreement with the Joe Master I have to select the pen first. Okay. Into an Joe Master under which the ChemClean will license Joe Master know-how and technology to manufacture a chemical compound. Volute. The know-how and the technology has fair value of 4 million, and ChemClean cannot use the technology, cannot use the know-how and the technology for manufacturing any other compounds than Volt. ChemClean has not concluded that the economic benefits are likely to flow from this compound. The economic benefits is the key to recognize any asset. So what is this? It is an agreement. It was entered in agreement with the Joe Master under which the ChemClean will license Joe Master know-how and technology to manufacture a chemical compound. So we have we'll get the license to manufacture a product that is Volute. The know-how and the technology has a fair value of 4 million. ChemClean cannot use the know-how and the technology for the manufacturing any other compound than Volute. ChemClean has not concluded that the economic benefits are likely to flow from the compound, but will use the Joe Master's technology for a period for 3 years. ChemClean will have to keep updating the technology in accordance with the Joe Master's requirement. The agreement stipulates that the ChemClean will make non-refundable payment of 4 million to Joe Master for access of the technology. Additionally, Joe Master will also receive 10% royalty from the sale of the chemical compound. Additionally, ChemClean is interested in another compound, Yactone, which is being developed by the Joe Master. The compound is in the second phase of the development. The intellectual property of the compound Yactone has been put into the newly formed shell company, Connie, which has no employees, and intended to acquire 65% interest in the Connie, which will give the control over the entity and the compound. ChemClean will provide the necessary resources to develop the compound. So you are required to tell the accounting treatment of the 4 million amount, the 10% royalty. What should be the accounting treatment for the 10 million, 4 million, 10% royalty? Then what we should have to do with the Yactone. The compound is in the second phase of the development. The intellectual property of the compound Yactone has put into the newly formed shell company, Kunai, which has no employees. The compound is the only asset of the Kunai. ChemClean is intended to acquire 65% interest in Kuni, which will give the control over the. So ChemClean wanted to acquire 65% shares, means the controlling interest in Kuni. So you have to tell the accounting treatments of these two areas of the agreement for the production of the chemical compound with the name Volute. and at the same time what to do with the yak tone, whether there will be an accounting treatment of IFRS 3 or what will be the impact of IAS 38. So you are required to just prepare just some notes for you so that we can discuss the matter accordingly. So I'm giving you just 1 minute to prepare just notes for this particular scenario so that we can discuss it in detail. So let's start discussing this. Now the first agreement is between the Chem company and the Joe Master company, in which we have the license of the know-how and technology to manufacture a chemical compound, the volute. So this license should be recognized as an intangible asset, because for the recognition of intangible asset, we have to meet certain criteria of IAS 38, that it should be probable that the future economic benefit will flow towards the entity and the cost of the asset can be measured reliably. So the probability of the future economic benefits will be actually associated with the fair value. Like if the Chem is ready to pay some amount to the Joe Master for the license, so it shows that the Chem is expecting some future economic benefits, therefore it is purchasing the license of Joe Master. So the license or the agreement should be recognized as an intangible asset. And further, when you prepare the product, finally you have to pay Joe Master further 10% royalty from the sale of the chemical compound. This royalty should be considered as an expense for the Chem and as an income for the Joe Master. And secondly, Chem is interested in another chemical compound, that is Yactone, which begins to develop by the Joe Master. The compound is in the second phase of the development. The intellectual property of the compound has been put into the newly formed company. So the intellectual property is actually converted into the company, and the Chem is interested to buy 65% shares of the Konai company. But do remember this, that this is not actually a business combination. You can see that we are acquiring the controlling interest in another company, but this is not a business combination, because in Konai company, there is no business involved, because there is no employees. We don't have any employees, we don't have any business. It is just an intellectual property. So the acquisition of the CONI is not a business combination. It is basically acquisition of an asset, which should be considered under IS 38. So both the acquisition of the CONI and the acquisition of a license for the production of volute chemical compound should be recognized as an intangible asset, and the first one should be amortized over the 3 years, because this license is actually for the 3 years. So these are the requirements of this question. So you have to discuss the provisions of IS 38, and you have to justify that the acquisition of the CONI is not a business combination. It is actually the purchase of an intangible asset. Okay. So we are moving towards the next slide. Yes, this is part B. In the year 30th June 2015, ChemClean acquired a major subsidiary. Now the business combination. The inventory acquired in this business combination was valued at its fair value at the date of the acquisition. So the inventory is valued at the fair value. The inventory increases in value as a result of the fair value exercise. A significant part of the acquired inventory was sold in the post-acquisition period, but before 30th June 2015, the year-end, in the consolidated statement of profit and loss and other comprehensive income, the cost of the inventory acquired in the business combination and sold by the acquirer after the business combination was disclosed on 2 different lines. The inventory was partly shown as the cost of the goods sold and partly as a non-recurring item within the operating income. The part presented under the cost of the goods sold corresponded to the inventory carrying amount in the subsidiary's financial statements, and the part presented as a non-recurring item corresponded to the fair value increase recognized on the business combination. The non-recurring item amounted to 25% of earning before interest and tax. ChemClean disclosed the accounting policy and explained in the notes to the financial statements that showing the inventory at the fair value would result in the fall in the gross profit margin. Okay. Further, ChemClean argued that isolating this part of the margin in the non-recurring item, whose nature is transparently presented in the notes, enable the users to evaluate the structural evolution of its gross profit. So can you suggest that from which accounting standard which we should have to solve this part of the question? Which accounting standard should be applicable in this part of the question? Is it IS2? IS2. IFRS 3, IS1, Wendy Lam. IS1, IS2, IFRS 3. There are a number of students who are telling about IS2, some are telling about IFRS 3. And so what is the issue here? Issue is all about the presentation of the inventory items in the income statement. So it is not, the issue is not related to the valuation of the inventory. It is actually about the presentation and the adjustment in IFRS 3. So you have to discuss some of the provisions of IFRS 3, then IS 1, and the requirements of IS 2. So there will be 3 standards that you should have to follow. So let's discuss what IS 1 says about this. IS 1 says that presentation of the financial statement provide little specific guidance on the presentation of line items in the financial statement, such as the level of details or the number of line items that should have to be present in the financial. Furthermore, IS 1 objectives to set out the overall requirement for the presentation of the financial statement, guidelines for the structure, minimum requirement for the contents. In doing so, IS 1 set out the minimum level of the requirement items by requiring certain items to be presented on the face of the. So these are actually some of the introduction of IS 1. You can ignore this part as well, but it's examiner's approach to write some base provisions about the particular standard, but if you ignore that part, it's fine. The current requirement in the IFRS do not provide the definition or many other common subtotals. The absence of this specific requirement arises from the fact that the guidance in IS 1 relies on the management judgments about which additional line items, heading, and subtotals are relevant to the understanding of the entity's financial position, financial performance, and should be presented in a manner which provides relevant, reliable, comparable, and understandable information. So for the calculation of gross profit, you have to select which item should be included in the cost of goods sold, which item should be removed from the cost of goods sold. But whatever be your selection, it should be relevant, it should be reliable, it should be comparable, and it should be understandable. Like sometimes you can calculate. Hello. Okay. Okay. Can you hear me? Can you people can hear me? Can you hear me clearly? Okay, yes, it's fine. Okay, IS 1 allows entities to include additional items amid the description and the ordering of the items in order to explain the elements of the financial performance due from the various activities, which may differ from the frequency and predictability. So, from the perspective of IS 1, you can amend the format of the cost of goods sold according to your requirement. Like you can charge a depreciation in cost of goods sold, or you can charge a depreciation in the operating expenses. So IS 1 just provide the basis, but it does not provide the specific requirements of how to calculate the gross profit and what amount should be included in the line items. IS 2 inventories required the carrying value of the inventory sold to be recognized as an expense that we do by charging this amount in cost of goods sold. In the period in which the related revenue is recognized, it is actually the rule of matching principle. The cost of sales are the costs previously included in the measurement of the inventory which has now been sold, plus unallocated production overheads and abnormal amounts of the production cost of the inventory. Consequently, the entire carrying amount of the inventory, included the effect of the fair value step up, should be presented as the cost of goods sold. So the most important point is that whatever be the amount of the inventory, when the inventory is sold, the whole amount should be charged in cost of goods sold. Transaction like business combination may have significant impact on the profit and loss, and these transactions are not necessarily frequent or regular. However, the practice of presenting non-recurring items may be interpreted as a new way to present the extraordinary item in the financial statement, despite the fact that extraordinary items are not allowed. So do remember this point, that extraordinary items, when the IS1 was last updated, the extraordinary items was removed from IS1. It can also be argued that the additional line items and subtotals as permitted by IS1 may add complexity to the analysis of the financial unit, which may become difficult to understand. Entities use subtotals and additional headings to isolate the effect of non-recurring transaction from the class to expenses or income. So in a very simple way, we must have to say that the adjustments in the value of the inventory because of the business combination is allowed. You can do the fair value exercise according to IFRS 3 for the calculation of inventory, but when the inventory was sold, the whole amount should be charged in cost of goods sold. So these are the requirements, and it's all about the presentation of how to present the inventory. When the inventory was sold, the company is charging the half amount in cost of goods sold and half amount in the remaining with the term non-recurring items. So presenting the information like non-recurring item or extraordinary items are no longer allowed. So you can present the whole amount of the inventory in the cost of goods sold. So these are some of the requirements. Here's drawings. So we are moving towards the next part of the question. So here we have we have discussed this part. Now here we have part C. So please read this part and try to solve this part and prepare just briefing notes. I am giving you just 2 minutes for this. So let's start this part of the question. In the consolidated financial statements of 2015, Chem recognized the net deferred tax asset of 16 million. Next, net deferred tax asset. So the company has recognized actually the deferred tax asset. Which represents 18% of the total equity. The asset was made up of taxable temporary difference of 3 million. Now there is a taxable temporary difference of 3 million against which we have to book the deferred tax liability. And there is a deductible temporary difference of 19 million. That is the carry forward losses. IS 12 says about the carry forward losses that you can recognize the deferred tax asset for the carry forward losses, but to the extent that the future taxable profits will be available against which the carry forward losses can be utilized. So when you carry forward the loss, there must be a taxable profit in the future against which you can adjust the carry forward loss, and therefore you can utilize these losses and will get the benefit. And if it is possible, then you can book the deferred tax asset. But if you know that your carry forward losses will be expired in the future and there will be no tax benefit in the future, so you cannot recognize the deferred tax asset. But standard says that there must be a convincing evidence that there will be sufficient taxable profits in the future. Okay. The local tax regulations allows unused tax losses to be carried forward indefinitely. Okay. ChemClean expects that within the 5 years, the future taxable profits before tax would be available against which the unused tax losses could be offset. So the management of the company is claiming that there will be future taxable profits against which we can recognize and adjust the unused tax losses. This view was based on the budget for 2015 to 2020. This is the future next year's budget. This is actually the forecast for the future. The budgets were primarily based on the general assumption about the development of the key products and economic improvement indicators. So the budget is actually based on some assumptions. Additionally, the entity expects a substantial reduction in the future impairment of trade receivable and property which the entity had recently suffered. So there are some losses in receivables and the properties which the company is foreseeing that it will be improved in the future. And this will result in substantial increase in the future taxable profits. So the calculation of the future is totally based on some assumptions. ChemClean had recognized that material loss during the previous 5 years. So now here we have got the evidence that in previous 5 years you got the loss. So how you can say that you will be in the future, because IS 12 wants convincing evidence about the future taxable profits. A comparison of the ChemClean's budget results with the previous 2 years to its actual result indicate the material differences. This is again a point that when you prepare the budget, your actual results and the budgeted result is totally and materially different. Relating principally to impairment losses. In the interim financial statement of the first half of the year, the ChemClean recognized an impairment losses equal to the budgeted impairment. So for the first half year, the company is recognizing the impairment losses according to the budgeted for the whole year. So the company has recognized the full amount of the impairment loss in the first year. So the actual amount of the impairment loss will be substantially different from what the company is expecting. In its financial statement for the year ended 30th June, the ChemClean disclosed a material uncertainty about its ability to continue as a going concern. The current tax rate in the jurisdiction is 30%. So these are some points that you are not even able to continue as a going concern. So how you can say that you will be converted into future taxable profits? So these are some evidences. The first one is there is a material difference between the previous year's actual and the budgeted. Second one is the ChemClean company has recognized the full amount of the impairment loss, and previously it was saying that the company was saying that the impairment loss will be reduced, but you can see that here the impairment loss is increasing. And finally, the company's going concern is in doubt. So on the basis of this, you can say that we don't have the convincing evidence that there will be future taxable profits against which we can utilize these unused tax losses. So the final comment and the final point is that you can only recognize a deferred tax liability of 3 million, but according to the provisions of IFRS 12, you cannot recognize deferred tax asset because we don't have a convincing evidence that there will be future taxable profits against which we can utilize the deferred tax asset. So this is how we can calculate, but there is no number gain involved, number crunching involved in this part of the question. You only have to discuss according to provisions of the standard. So if you have any confusion, you can ask it immediately. Otherwise, please repeat the last point. I'm just saying that there are few points on the basis of which we can say that the deferred tax asset cannot be recognized, because IS 12 says that there must be a convincing evidence that the future taxable profits will be available against which you can utilize the deferred tax asset, and if it is possible, then you can only recognize deferred tax asset to the extent of the amount that we have recognized. So if it is possible that you will get the benefit in the future, you can recognize to the extent of the amount that you can find it profitable in the future. So you cannot recognize deferred tax asset in this question because of the fact that the company's assumptions are not working, the company's budgets are not realistic, and the company is facing some going concern difficulties. So we cannot say that the company will be in taxable profits in the future. So on the basis of this, we cannot recognize a deferred tax asset. So the point is, for the 9 marks, so you have to write for 9 marks at least 1.8 into 9. So you should have a material to write 1.8. So to get the 9 marks, you should have to write at least 14 to 15 minutes. So 14 to 15 minutes means for a 9 marks question, you should have at least 8 to 9 ideas about deferred tax. So the first 1 or 2 marks will be given to you on the basis of the knowledge of the standard, and the remaining will be given to you on the basis of the relevant discussion and the justification of your answer. Okay, so next, there is a suggestion from the student that can we cover IS 41, IFRS 15, IFRS 16 financial instruments in detail, particularly hedging accounting, tomorrow? I have a plan to cover uh, IFRS 15 in detail tomorrow, and we'll be discussing some of the key provisions of financial instruments. But on Friday, I have a plan to discuss IFRS 16 in detail with some of the provisions of again financial instruments. But if you want that I should have to discuss the hedging, then we can discuss the hedging on Friday. So tomorrow we'll be discussing the provisions of IFRS 15 and some of the provisions of the financial instruments. But do remember this point. Tomorrow I will give you the mock exam on which you have to attempt it on the Friday. And we will discuss that mock exam on Saturday. And it's highly recommended to please stay connected with me, stay in touch with me till the exam date. I will provide you 100% support, and I will share some useful summaries of the IFRSs, and I will give you the list of the questions that you should have to attempt before appearing in the examination, and I will give you some extra mock exams to solve. There are 2 points that will ensure that you will pass this exam. The one thing is the knowledge of the IFRS, and the second one is your 3 hours practice. So you have to solve at least 3 mock exams of 3 hours if you really wanted to pass the exam in first attempt. So how much time we have still? Only have 2 minutes, I think. So if you have any question about this session, about this part of the question, you can ask it immediately. We only have 2 minutes left. My recommendation for all of you is to attempt all the 3 questions. The first one is the diamond, which I have given to you. The second question is related to, I think, Guinea and Boo company, which we have covered in the day 2 handout. And today we have covered the question of bubble group. So the first question is relating to the acquisition and disposal of balance sheet. The second question of the past paper is relating to the acquisition or disposal of income statement. And now we are discussing, today we have discussed the foreign currency question. And tomorrow we will discuss, inshallah, IFRS 15 in detail, and we'll discuss some of the key provisions of the financial instruments. And we'll pass up to you. Section B questions is so difficult, while question 1 is time consuming. Section B questions are not difficult if you have practice. I think when you do some practice in this part, I think 4 to 5 past papers, you will feel some confidence in you. But you have to do some practice for at least 4 to 5 past paper questions. And at the same time, question number 1 is, yes, it's time consuming. So you have to prepare yourself that you can attempt the question paper in just 3 hours. And tomorrow I will give you the mock exam that you should have to solve. Do you have the handouts of your sample answers? Right now I don't have the answers of these questions. You can refer to the past papers answers, but if you want a particular question, we can solve it on the board in the next class. If you want any of the answer of the question, we can solve it on the board. Okay, there's a question that clearly the asset cannot be recognized. Does the 3 million liability have to be recognized, or it can be argued that but the liability can be offset to the losses brought forward? So what would be the deferred tax be, 3 million liability or no asset or no liability? There will be a liability. There should be a liability of 3 million that you should have to recognize as a deferred tax liability. But if it is probable that you will receive the future benefit from the unused tax losses, then we can recognize the deferred tax liability as well, deferred tax asset as well. But for this question, we only have to recognize 3 million as a deferred tax liability. So thank you very much. Take care, and we will discuss the matter tomorrow. Thank you very much.